Welcome, everybody, to our Short Verticals webcast. I'm Connie Hill, sitting in for Brett Crowther for a couple of weeks while he's off having a good old time. All right, we deserve to do that once in a while, right? Happy you joined me here today. How many of you have been in a situation before where you're trading short verticals and your emotions kind of get in the way? Meaning you think a trade's going against you, and maybe it actually is going to turn out just fine. I'm going to show you a tool here today that you can use that might help your mental psyche when you get a little bit stressed when a trade doesn't look like it's working out for you. Okay, we're going to spend some time on that. Hopefully, that'll help you feel a little bit better managing your trades. Now, I'm happy we have Scott Thompson out in the chat today. Scott and I have been very busy being chatters. But we're here to answer your questions. I'll keep my eye on the chat, and Scott will as well. So as you have questions, chat those in. We want to make sure you get answered. The other thing, we want to make sure you're following us on X. I'm Connie Hill CS. Scott is Scott Thompson CS. We'll post educational content out in our X account. Things that we might notice going on in the market, we share with you. So it's free, it's easy. Go ahead, follow us and join along. Let's go ahead and run through our disclosures. We've got a pretty full agenda for you here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes. Don't consider it a recommendation. We'll be using the Paper Money software application. It's what you download to your computer. It's a fantastic educational tool. And if you're somebody that's maybe just getting acquainted, say, with short vertical strategy, doing it in a paper scenario really helps you understand the rules, helps you feel comfortable with the strategy before you start tippy-toeing into your live account. One thing that is different about paper money than a live account is they will not assign short options early. That's especially important in this particular class if we have in the money options, because the live market could assign you early. Past performance is no guarantee of future results. Keep in mind, we'll place some stop orders as we place some trades sometimes. And remember, if it's a market stop, that it will not guarantee an execution at or near the activation price. Once activated, they compete with other coming orders. All right. Some of you are saying you could use some help with your mental psyche. Yeah, we're going to give you a little tool here to help you out. All right, so we're going to just talk a little bit about short verticals. Sometimes we have people that are newer to the strategy. I want you to be able to follow along with us, what we're discussing. I was here a month ago. We're going to follow up on a couple of trades that I did a month ago. Let you see how those turned out. We'll discuss those, and I have several trade examples I want to go through here today. So we'll see how many we can get through. All right. The little thing about short put verticals is you want to have the right kind of candidate. So it's a bullish trade. If you're doing a short put, we're in a bullish environment, right? And so it can be in a little bit of a neutral trend. Maybe it's been upward trending, maybe flattening out a little bit. That's okay. We're really looking for stocks with higher volume of open interest so that we can get in and out easily. So we'll key off those two things. Open interest is the more important number, but sometimes volume can play a role in there. That helps us get what's called a tight bid-ask spread, which means the difference between the bid and the ask is smaller. It's very tight. That gives us an easier opportunity of being successful in our trade. There's not as much room to make up of the money that we have to give to the market maker. Last idea here is some things to think about. And this is where we're going to get into the psyche thing. When you're selling strikes, typically you might want to sell them out of the money. We're going to be talking a little bit about risk and reward and probabilities. Okay, usually we're going to go about 20 to 50 days worth of time is kind of a sweet spot the traders sometimes like to use. Sometimes traders will have a minimum return on investment that they want. That is just fine. And you may run some scenarios where you don't get the minimum that you want personally. And so you might just pass them by. In fact, I had an example that we may or may not look at today that's kind of on the fence, right? Sometimes traders like to get at least a 30% return, or sometimes they'll say, I want at least a percent return for every day I'm in the trade. So if it's at the longer end of the window, say like a 50 days, they might want a 50% return. So paper trading that can help you identify where you feel comfortable, right? Because it's where you want to be. So in this, on the outlook here, we're looking for the stock to be bullish or in a sideways or trending pattern. Okay. It's nice if the market's bullish too. It's nice if that sector or industry group is bullish too. We're looking for all those things that would give the stock every reason to go up. Not that it's guaranteed to, but we'll look for certain things. Now let's head over to paper money. And you guys probably know the markets are a little bit up right now, or down a little bit earlier. I'm going to do a quick check of the NASDAQ, see if it's still hanging in there. Yeah, it's giving us a nice little bounce. It's only down 0.13%. So not very big. So what are the markets doing? Man, we have had, what, 9 weeks of increasing highs, and all-time highs happening over and over again. So just yesterday, NASDAQ was at 30,000 plus, almost 31,000. So, you know, the adage of sell in May and go away would not have been a good strategy last month. We'll see what June brings. Sometimes the summer months are slower, but we've got a lot of things that are just taking off, right? It's like they come out with their earnings and it's like throwing gasoline on the fire and off they go. It's nice when we can catch some of those, right? Yeah. All right. I want to look at a first example. We're going to take a look at stock. May have heard of them before, GM. Now, GM comes from this little watch list I have called Liquid Options. It was actually a scan that I taught you when we were here together a month ago. And so we're going to use this little results of the scan for a while, and we'll look for them for bullish trades, bearish trades. Either one is just fine. We set it up so there would be a lot of liquidity. Now on GM, you can also see a little bit more information that I have on the stock. Have this column I'm pointing to here on the left is a 1-month return. The other column here is a 3-month return. So it gives you an idea, hey, is this one of these stocks that is just like exploding? Or is it maybe more of a steady Eddie type of a thing? Now I'd say on GM, it's up 5+% this month, up 10% this quarter. So I would say it's not maybe a huge runner, which is why maybe somebody would say, well, I like the entry, I like this stock, but maybe I won't do such an aggressive strategy. Maybe I'll do something like a short put vertical. Okay, that's what we're going to do on this particular trade. We're going to head over here to the trade tab. We're going to come down to the July options. We're going to be using these. That falls in our 20 to 50-day window. Some of these stocks are quite liquid, but they might not have enough open interest at the strike prices that we need. I checked them out in the 22 days and the 28 days to options expiration, but none of them were like a ton of it. Okay, so we're just going to go for the July 17th. There's plenty of open interest here. Now, I want to draw your attention to my column headings. Since we're on the put side of things, we're going to go on this side. So delta open interest, volume, which is today's activity. This first column here is the probability of an option expiring out of the money. We're going to reference that here today. This other column right over here, this is the one that's going to help your mental psyche. This is called the probability of touching. So let's go take our first example. We'll talk about the probability of touching here. Strike prices, let's see if these still make sense to use. I was looking to do the 80 and 77.50. Okay, lots of open interest here. That is nice. I'm going to queue this up and put it in the trade, but then we're going to kind of come back here. So we would be selling the 86 or the 80 strike price as a 36 delta. The probability of it expiring out of the money come options expiration is about 59%, which is, you know, when we get to about 60%, that's when people will say, okay, this is higher probability trade. So it's right there on that borderline. The probability of touching, that's what I want to talk about here today. So the likelihood that this could expire out of the money is about 59%, but what's the probability that the stock might go and touch 80? Well, it might go and touch 80. There's a 78+% chance that it might do it. So sometimes we get a little down on a trade and sometimes we're like, oh, I don't know, this doesn't seem to be working out so well. But if we know, because we looked at the numbers beforehand, if we know, hey, there's probably a 4 out of 5% chance that at some point during the trade, it is going to go and hit 80, then that can help you breathe a little bit easier, not psych yourself out so much, right? Let's go look at where 80 is on GM's chart. And I'm going to go put my mouse in that area. So down here, ooh, that's about as close as I can get. I'm going to leave it alone there. It's about 80. We have a little bit of leeway here, right? Stock's at 83. We could let that stock just go sideways. Trade could still work out for us. Would love for it to continue the bounce up. That would help us get to our target profits a lot more quickly. But it could also go down a bit and we could the trade could still work out for us just fine, right? It very well could. So we do have like about a $3 cushion. But if you know there's a 4 out of 5 chance it's going to go touch 80, you're probably not going to freak out about it as much. Okay. At least that should give you a little comfort knowing, okay, it might go touch that. That is very likely going to touch that before the trade is over. So just keep that in mind. Okay. It doesn't mean that it has to expire there. All right, let's go talk about this trade, see if it meets your particular trade parameters. So we've got 80 and 77.50, so it's a $2.50 wide spread. I'm going to click on this lock so we can work with some numbers here. So we are risking the difference of 250, which is the difference in the spread price, I should say, 250 minus 0.85, which is our max theoretical gain. That's saying we're willing to risk $1.65 to make 85. Does that make sense? Some of you might go, well, that's a risk-reward ratio that's opposite of what I thought we were looking for. And in this type of strategy, and I'm sure Brett's talked about this before as well, in this kind of strategy, it's a probability trade, right? It's hey, probability is in our favor. There's a 59+% chance it'll expire out of the money, which means what? It means the trade's working for you. But we know it could come down and touch it. There's 80% chance that's going to happen. Okay. But we're willing to because of that higher probability of success. So in this case, let's collapse our watch list here. And we're going to bring out the calculator. Let's take a look at real quick. Mark says the probability of expiring cone for GM is almost 20 points wide on 7/17. Now we're not going to use the probability of expiring cone, but the 20 points, it's 20 points wide come July 17th, which would be options expiration day. We're hoping to be out of the trade well before options expiration day. But it's nice to know, yeah, there's a kind of a 20-point range that it could potentially go. That's kind of a wide range actually on GE. Interesting. Oh, there is a survey. Yes, Mark's saying, hey, folks, we've got a survey out in the chat. Those of you that have been with us know that we will throw a chat out there. I don't control it. Scott doesn't control it, but other powers that be control it because we like to get your input from time to time. We try not to do it too often, but we really appreciate it when you fill that out for us. And so if you'll just click on that little link, let it sit in the background when our session's over, fill it out. There's 2 questions. You just fill in the radio button, plop, plop on a scale of 1 to 10. You just put your answer in there. And if you want to answer some questions, you're free to do that as well. We love hearing that feedback. I'll also encourage you to say, hey, if there's something you want me to communicate with me, to say, hey, could we cover this in an upcoming session? I love to incorporate your ideas into coming sessions. It lets me know where you're struggling. It lets me know maybe kind of what some of the thought processes are so that we can help you. So I'll remind you at the end of the class that survey's there. Scott's going to post it frequently so that you have an opportunity to fill it out. And again, everything you submit, I will read and Scott will read as well. Okay, so getting back to our trade here, let's grab the calculator. And maybe we can kind of move it over here a little bit out of the way. So if we have, what was that? That was 285, right? No, it wasn't 285. It was, I have to get the right number, 165, and I've got to write it down. All right, 165 is what we're willing to risk per trade. Now, in your account, you may have a different threshold than what we're going to use for our trade here today. Okay, our trade here today, we are saying that we have a $200,000 portfolio. We're willing to risk 1%, which means we could risk $2,000 per trade. Do we want to lose $2,000 per trade? No, of course we don't. However, we've got to have a threshold, and we're going to try to keep our risk parameters within that and not exceed it. So many times people just, when they're position sizing, they'll position size for a max loss like we're going to do, but we don't want to end up there. Okay, so $2,000 divided by $165 says we could do 12 contracts. Now, you might not feel comfortable with this number of contracts. Right now, you might be comfortable even in paper money trading one contract. Okay, do what is comfortable to you, especially when you're learning and you're like dipping your toe in the water. You're like, start with, you can be capped in one lot, and there's nothing wrong with being capped in one lot whatsoever. But let's go ahead, let's do our 12 contracts here. And then we're going to put in a profit target. We're going to change that to a first trigger sequential, and we're going to say, hey, when we get a chunk of this, we're going to get out. We're not interested in squeezing it to death. All right, we're interested in saying, I am happy with this little chunk that I was able to get, and out we go. Now, I will ask frequently what your percentage number is that you're comfortable with. Okay, and it's going to be different. It depends on if you're more conservative, depends on if maybe you're more aggressive. It might depend on your experience level, what you decide, and it may change up a little bit per trade, although you may settle in on a range. A lot of times is what will happen with people. So feel free to chat in where your comfort zone is. We'll use that at some point. For this first trade, we're going to say 60%. We're going to say if we get 60% of our 85, we're going to be happy campers. All right, so let's clear this out. 85 cents times, I'm going to go with 0.3, because if we've captured 70, 30% is left. That means, okay, if this gets down to 25 cents, we want it to go execute the trade for us. All right, let's go down here. I think that was 25. I could have written it down, but yeah, it was 25. We'll go with the 25 versus the 26. We'll make that a limit order. We'll make it good till canceled. And we're just going to let it sit out there. So some of you like 50% on this type of a trade, says Bogus. Sharon likes 70 to 80. Mark likes about 70%, but you'd get out earlier if maybe it was looking good and you're like, hey, let's grab a bird in the hand, right? Type of idea. Lock in those gains, because even though we might be up in a trade, we're really, nothing is final until we actually get out, right? We go back, we buy it back, remove our obligation. Now, there may be some situations when you don't go buy it back. In our class, typically, we're always going to go buy it back. We're going to err on the side of caution and not risk a few more penny, or not risk a lot of the trade we've already gained to just pick up a few pennies. Okay, that's kind of the outlook we're going to have here. So we'll go back, buy it back at 25 cents. And again, your number might be different. Equities likes 50% out. You say, I get 50% and you're happy? Great. Let's hit confirm and send here. And I can't remember if I still have a short verticals bucket. I don't. I will create one so we can track this trade. We'll see how it's going next week when we get into it. All right, let's look at one more setup before we go look at a couple of trades that executed for us. Next one up, and this is on the list as well, is Merck. Let's look at that Merck chart. What's going on with it? Well, it had a high here getting pretty close to the 124 high that it had here in April. It's pulled back. Looks like maybe today, assuming if the market were to close right where it is right now, would have a hold here. Sometimes people like to get in on that hold. Sometimes with short verticals, some people like getting in down here at support and not waiting for a bounce or waiting for a hold. Okay, so just keep that in mind. And we've got that diagonal support line there letting us know, yep, that's exactly where it came back to. And it's still making higher highs and higher lows. So we're interested in this one, and some might use that as an entry signal. Now, as we head over to the trade tab here, same thing. We're just going to use these July options. Look at the liquidity. Doesn't that give you warm fuzzies when you see 3,000 contracts, 6,000 contracts, 1,650? Oh, yeah. That makes us happy as traders. We love seeing that. And this is a pretty decent spread, 20 cents on a, say 550, 530, 550, and it's a 20-cent spread. Yeah, that feels nice. Okay, so we want to be looking for that, that type bid-ask spread. Now, many traders will sell a 30-something or a 40-something delta. This one is just kind of right smack in the mid 30s here, right? We've got 115. We're just going to say sell vertical. And looks like at this point, we're looking at about $1.43 credit on a $5 wide spread. Okay. Let's see if this is worth pursuing. And one thing we talked about in the slides was, sometimes people use a measurement. I want X% profitability in the trade in order to want to move on with it. So let's make sure we calculate it here on Merck. So we've got a $5 wide spread. And so we're willing to risk 357 to make 1.43. Okay. Let's just run that number, and then I want to go look at our columns here. So $1.43 divided by 3.57 is about a 40% return. Now, if somebody were using the standard that they wanted 1% per day left in the trade, it might fall a little bit short of that because there's 43 days left in the trade. For our purposes, for our class, we're happy with that. Okay, let's look at probabilities now. There's a 61% chance this will expire out of the money come options expiration day. So let's tick the box that it's higher probability. What's the likelihood that it might go and touch 115? Now we have a $4 and a little bit buffer, right? Because the stock's at 119. We want it to stay above 115. So it gives us a little bit of a bar there, but there's a 3 out of 4% chance, right? We've got almost 75% chance there that it'll go touch 115 at some point before the trade is over. Now I'm just going to come in here. This time I'm going to mark it where our 115 is. Ooh, I'm going to get it as close as I can. Ooh, there's 115.07. Okay, so now we know where the boundary is. It can go flat. It can go up. We're expecting it to go up, although it might not. But if it goes up, it helps get us to our target of profit faster. Could go sideways. It could retrace. I mean, it's bouncing here off the 10 exponential moving average. It might come down here to the 30. 30 is not that far down. Could come down here to the diagonal support area. Okay, so 3 out of 4% or 3 out of 4 chance that it is going to do that. So again, with the psyche, if it comes down and hits 115, do we need to panic? Do we need to think, oh, the sky is falling? No, we don't. These are trades of probability and patience. I'm not the most patient person in the world, but this kind of trade requires a little bit of patience. Okay, so let's go take a look here. Looks like Scott's helping me out there with those, so I appreciate that. Let's go back to our trade tab here. How much can we do in this account? How many contracts can we do? Okay, hopefully you're getting really good at this math. Short verticals are a little bit math intensive. That's all right. I guess verticals in general, whether it's long or short, there's a little bit of math involved. But if we have a risk here of, what do we say, 357, we're going to take our $2,000, divide that by our risk of 357 per trade, and we can do 5 contracts. Now, if you should do 1 contract in your account, just do 1 contract, right? Not a big deal. And I would say as you're practicing, if it's easier to do the math with 1 contract for you, great. If you're feeling comfortable with position sizing and like, oh, I can do 4 contracts, practice with that as well, okay? Because that's going to help you learn your personal thresholds and what's comfortable to you, right? We all want to be comfortable with what we're doing. All right, we're going to do a first trigger sequential. We're going to do that. We're going to put in an opposite trade. And again, we're not going to put a stop on it. It is already a hedged position. And we are going to, we position sized it for a maximum loss. We don't want to take the max loss. We would like to get out before then. If somebody wanted to put on a rule, they could. In fact, we'll talk about that a little bit next week. Okay, if somebody wants to put a stop on at the same time. In this case, all right, some of you said, there were lots of you that said you liked getting out around the 50%. There were some 70 to 80s, some 50s. This one, let's go with the 50% people. Okay, this one's for you. So 50% of $1.43 is going to be what? It's going to be 71. So we're going to say, all right, we're willing to go buy this back at 71 cents. So let's go plug that in. Means we're not trying to get every penny out of it. We're just saying, hey, if we get 50%, we'll be happy. We'll make that a good till canceled as well. Yeah, I'm just going to click on this to see if it's changed much. Ooh, it's changed to $1.45. We're still going to stick it back at $1.43. See if we get filled. If we don't get filled by the end of the class, we'll go take a look at it. Okay. Let's see. Yeah, thank you for, I'm gonna just repeat this about the probability of touching, okay? And Scott's helping out here. It says, you'll see that those probability of touching numbers change as the stock changes, right? As the stock price changes, every number on the option chain changes, right? The deltas change, the theta changes. Probability changes, probability of expiring out of money, as well as probability of touching. If a trade is going your way and you're getting closer to options expiration date, this number may change. If you are further out of the money, okay, like suppose somebody were more comfortable selling the 110, the probability of it touching is only 46%, but it does have a higher probability here of expiring out of the money. So you're trying to, determine that balance that's comfortable for worth the risk for that higher probability trade. But yeah, those numbers, everything changes every time the stock changes and as time ticks off. All right. I do have a couple more trades I want to show you, but I do want to follow up on some trades we did with, last time I was here. Okay. And so let's do that. First trade we're going to take a look at, and I did not mark it with the dots like I usually mark the chart up with dots. I did not do that in this situation, but we did a Dollar General trade. I was here on May 7th, so that's about right here on this day. Had been downward trending and looked probably at the time during the day, it was looking like it was probably bouncing down off that 10 moving average. Okay. The day that we got into the trade. Did we do a bullish trade or a bearish trade? We did a bearish trade. Absolutely. Sometimes you pick on losers continuing to lose, right? That's bearish strategies are all about. Typically, we're not going to go counter trend. We're something that's bullish. We don't typically like to do bearish trades on them. Okay. It's a higher probability. You stick with the direction of the trend. So on DG, we were in it for a little bit of time. Now I'm having this go back about 35 days so we make sure we capture everything. On this, we did a short, like I said, short call vertical at bearish. We brought in a $1.39 credit and we said, hey, if we can go buy it back for 40 cents, we'd be happy. So we put that in there in our order and it hit it. We got filled at 39 cents. So we got a little, we got a penny better. So that net there is $1 times 5 contracts. That was about a $500 gain, not including commissions, right? We're just doing the numbers simple here. How long did it take? Well, it didn't even take till the next week. Well, it did go the next week, right? But the next class day would have been the 12th, okay? And this one got out on Wednesday, the 11th, earlier in the morning. What did the 11th look like? The 11th, I think it was, let's see, 513, 512, right there, this big candle day. Now, sometimes people say, oh, well, I'm watching it, I'll just try to catch it. You can do that, right? Sometimes it's hard to be watching everything you want to watch and still have your life, right? And so being able to put in that order ahead of time saying, I'll be happy if it goes here, can make your life easier. Okay, now it did continue to drop. Somebody could have maximized that, maybe got a little bit more out of it than we did, but we're happy with our gain. Okay, we are happy campers. So that was DG. The other one we did was a bullish trade on Coca-Cola. And let's find our day here. May 12th. So let's see, that was the 6th. We got in on May 7th, I believe. Okay, that was when we had our class. And so in this case, we were looking bullish. We have a couple moving averages heading more in a bullish direction. It looks like on this one, the cue that we took was just sitting as support, right? We talked about some people might wait for a bounce, wait for a breakout. Some people might like to get in right at support. Now, it did go up nicely for us, right? It did go up nicely. Let's see when we got out. On Coke, we brought in a 71 cents credit. We said we'll be happy if we can buy it back for 24 cents. Be out. I can't remember what that percentage is, probably 70-ish. And then they filled us right exactly where we asked. Okay, how long did this trade last? A little bit longer. We're in this trade for a couple of weeks. Okay, trades of patience. Coke doesn't really make enormous moves, right? So it's just kind of chugging along here, just gradually going up. And what was that date? The 19th. So the 19th was this day here, where it kept going up. It had a nice little bit of a run, and then it pulled back later in the day. So yeah, we were just kind of hung in there and let it do its thing, let theta decay work in our favor so that we could be collecting that premium. All right, so that just kind of shows you what can happen. Doesn't mean it always will happen, but what can happen when you put a profit target in there so you're not trying to sit there and catch it, okay? Sitting and catching doesn't always work the best. Okay, excellent. I'm going to give you a little plug here. I hope you are all subscribers to our Trader Talks channel. It just makes it so much easier to find our content. When you become a subscriber, let me get to the right window. I might not have the right window here. Let me just check real quick. That's not the right window. Let me get the right window. I'm going to bring up the right window and drag it over. When you become a subscriber to the Trader Talks channel, let's just see what's going on. Yep, we're in our short verticals class here. What's up next? Trading with ThinkScript. Mike Faribault does a fun class with that. Those of you that might be maybe a little bit newer to ThinkScript, don't be intimidated with that class. Mike makes it really easy. He works a lot with some simple scripts. He shares scripts with you. He does a lot of little scripts that he puts into scans. And so he's not out there saying, hey, let's go be supercomputer programmers, okay? He's not doing that at all. So I don't want you to shy away from that class. He does a great job in there. And then people that are maybe very, very new to investing, we've got this new to investing class. It'll be our last class of the day. That'll happen at 4 Eastern today. Okay, helps you find our stuff. We can see what our playlists are. You can go back. You can go back to the short verticals playlist here, see some of the classes that have been taught in the past. And some of you might be following along with those and you want to see how those particular trades turned out. Okay, let's do one more trade here. And oh, I'm going to have to go eeny, meeny, miny, mo. Okay, we'll go with this one. GE Aerospace. Is it trending up? Yeah, it is. Is it above a 10 and a 30 moving average? Yes, its RSI is showing some nice momentum moving into it in a bullish manner. And what has it done here? It's had a little pullback. Some people might just love that as a hold day, right? A close above the high of our low candle day here. Now, we do have a little bit more time before the market closes, maybe an hour and a half or so. So it's not guaranteed it's going to be a hold, but at least at this point, we know it's trading above the high of the low day. Okay, let's go see what kind of options are available here. Again, we're going to go out to the July 17th. Love looking at all this open interest out here. Bid-ask spread, I mean, it's a tiny bit wide on some of these premiums that are a little bit bigger, but 1010 by 1065 is only about 55 cents. That's going to be about a 5% spread. And so how did I get that number? Take the difference between the bid and the ask and then divide it by the ask price. Okay, that gives us an idea. Okay, that's what the spread is that they're charging to match us up with somebody on those contracts. All right, we're going to do a 310, 300 short put vertical. Notice a pattern that we're doing here. We're looking for a 30-something delta. We're looking for open interest. And so we're just going to do, this one was a what, 32 delta. So we're going to sell that, and then we're going to come back and just look. Okay, what's the probability of it expiring out of the money? About 62%. Okay, so higher probability. What's the probability of this option touching, going down to 310? I shouldn't say the option, but the stock. Stock right now is at 326. So we have a little bit of leeway here, right? We've got about $16. And so there's a 72% chance it might go and touch 310 when everything's said and done, right? It might go there. But if we know our probability that it'll expire out of the money is still on the high side, again, hopefully that can ease our panic when maybe it doesn't go exactly the way you thought it should go from the get-go. All right. Let's see, Mark says, if we're doing eeny, meeny, miny, mo, I think you should look at MO. Well, that wasn't on my list, but we could maybe take a peek at it and see. Let's go into our make sure this trade is going to be worth it to us, right? What is our return on this? Now I'm going to come in here and lock this up, grab our calculator. Now this one is a $10 widespread because the stock's a little bit more expensive. Sometimes in these weeklies, we get more frequent intervals of strike prices. This one didn't do it, but sometimes we get it. But I just wasn't seeing lots of open interest that we want to see. Okay, so we just go where the fish are, right? That's where we want to go fishing. So 305. So $10 from 305 should put us what at 595. Mr. Calculator. Make sure I'm not lying to you. All right, so 695 is our max theoretical loss. We are willing to risk more than what we have to gain, the 305. But because it's high probability, we're all right with that, okay? Let's see what that, and I'll just write this number down, 695. Let's see what percent gain that would be. We take our max gain, divide it by our max loss. So 305 divided by 695, a 43%. Now, again, that might meet your parameters, might not, just depending on what you like to see, where your comfort zone is, okay? For our class, for our purposes, we're happy with that. We're gonna need to leave this here. So we're happy with that 43%. Well, how many contracts can we do? If we are willing to risk $2,000 per trade, and we know our risk here is $695, we can just do 2 contracts. We're not going to round up. I know it's going to be tempting, but we're just going to stick with the 2 contracts here. Some of you with maybe an account where you can't risk it, say more than $500, this might not be one that you would choose to do, because you might go, oh, sorry, that just exceeds my risk. Now we're going to do a first trigger sequential, put in an opposite order. And I am going to decide what our percentage is going to be here. We are going to go with 70%. Okay, so if we get 70% of 305, 30% is left. So we'll times that by 0.3. And we're saying, okay, we'll go buy back at 90 cents. Okay, and we're going to be happy with it. Again, your numbers might come out a little bit different, whatever your comfort zone is. Let's go ahead, good till canceled. Let's do the 2 contracts, and we're going to send this off, and we're going to follow up on it next week. Oh, good, we got filled on that. I'll go back and see if there was anything we didn't get filled on, because there might be something still sitting out there. Let's just look real quick. Looks like both of those trades, I'm going to have to go out and do, oh no, those are our buybacks. We got filled on them. We got filled on our GE, our Merck, and our GM. All right, we are all filled and ready to go. All right, you guys, let me see if there's any questions here that I need to wrap up with. NVO BJ says, no guarantee it goes up. Absolutely true. But we trade what we see and we like what we see. Yeah, you kind of decide, do I like the look of this? Does this setup look realistic to me? Does it look like it's going to keep going up? As opposed to catching something on a peak that's dropping, you know, then we might not be quite as interested in that timing of something like that. Very good. Well, you guys, you've been a fantastic class. Appreciate your participation. And we did 3 new trades. We just saw what those were: GM, UNH, no, not UNH, Merck, and then GE. Okay, were the stocks that we did. Looking for lots of liquidity there and getting out on a profit target. Okay, seeing, okay, it might have a high probability of expiring, but it might go touch that strike price sooner. We're not going to let it get us, you know, freaking out, right? Oh, the sky is falling. Don't need to do that. Just go, oh, yeah, I knew at the beginning of the trade there was a 70% chance it was going to go touch that strike. Okay, so keep that in mind. See if that helps you. And I want you to report back to me next week if seeing that number, referring to it, that mentality gives you a little bit more peace of mind. Okay. Again, there was a survey out there. Anytime you fill out the survey for us, we totally appreciate it. If this was helpful to you today, make sure to hit the like button on your way out. That'll help other people find the webcast as well that are looking for, say, a short put vertical strategy. And then Scott and I would love a follow on our X, Scott Thompson CS, Connie Hill CS. And again, if you're not a subscriber, I don't know what you're waiting for, but there might be a few of you out there that haven't subscribed yet. Just makes it easy to find our content. So going to take a little bit of a break. And then our next class, like I said, is going to be Mike Fairborn teaching Trading ThinkScript studies. All right, you guys, have a nice break, get a fresh beverage, and we'll see you back here in about 15 minutes. Bye-bye.